Digital assets such as Bitcoin, Ether, and Cardano have been at the very sharp edge of an asset class on the rise. Yes, today we're discussing cryptocurrencies and how they may impact your tax bill in the United States government. Also, you'll learn some legal ways to minimize the tax burden that you might be experiencing with your cryptocurrency profits. In its current form, cryptocurrencies were spearheaded by Bitcoin when the Genesis blockchain was mined in January of 2009. According to Satoshi, and yes, we're just paraphrasing, there was a need for a global currency and the means to transact beyond any one government or organization. At its core, all Bitcoin is a ledger. However, the implications of that ledger were and continue to be amazing. The Bitcoin blockchain solves the problems of trust and reporting without the need for a third party. In essence, the trust and resulting processes that uphold all the money in the world were placed into code and birthed on the internet. Since 2009, there have been leaps and bounds gained by the crypto industry, which leads us to where we are today. After a decade of being ignored and jeered, cryptocurrencies are here to stay as they provide a much needed economic service. Because of the lost decade, rules and regulations are being rushed into law to corral the industry without understanding it. Income, profits, and losses experienced by individuals and businesses must be reported to the IRS. Uncle Sam wants his slice of the crypto pie. What is a crypto asset? Well, that's what we're here to talk about today. A crypto asset is any form of value represented on a blockchain ledger that, 1, functions as a medium of exchange, or 2, is a unit of account, or 3, is a store of value. That is considered a cryptocurrency. Hey tax saver, if you're somebody that's looking to get started in the crypto space, then feel free to get started by using Coinbase. It's a great crypto platform that allows for you to purchase, buy, sell, and trade cryptocurrencies. By visiting the link below, you'll be able to get $5 in free Bitcoin just for getting started. Now back to this video. The Infrastructure Investment and Jobs Act takes the definition further and instead of zeroing in on cryptos, throws a wider blanket with the phrase digital asset. The bill defines a digital asset as any digital representation of value which recorded on a cryptographically secured distributed ledger or any similar technology as specified by the Secretary. Interestingly, the Secretary in this instant would be the United States Secretary of Transportation. Now that we have a set of understanding, let us discuss how the IRS treats crypto, the income from crypto, trades, and even exchanges. Firstly, even with currency included in the name, the IRS views digital assets as property, not currency. This makes a huge difference and in a very interesting way admits the legitimacy crypto has been denied over the years. Where the maximum tax rate on income caps out at 37%, on capital gains it caps out at 20%. The IRS is sending out action letters to over 10,000 crypto income accounts, and it's expected to send out even more shortly. For trades and any other activities, it's very important to aggregate all your transactions to a crypto tax software that has the correct forms for reporting and that is going to aggregate all of your transactions to calculate gains, losses, and income easily. But note, all of the conversions must be represented in United States dollar based on the fair market price at the time and date of conversion. So let's talk about what a taxable event is in the crypto space. If you're selling crypto for fiat or trading one crypto for another, or using crypto to buy goods or services, earning crypto as a payment for work done, in some cases, based on how and what the digital asset is used for, foreign bank and financial accounts FBAR reporting is required and is needed to be filed on Form 114. Thus far, we've spoken on the trading side of assets. This is the easier portion of our discussion because IRS and other arms of government have given specific instructions on how to treat the trading of digital assets. So the million-dollar question is, where would the NFT part fall? Firstly, an NFT is closer in relation to a collectible, a work of art, or an autographed piece of memorabilia. With that difference as compared to trading cryptocurrencies, the nature of an NFT is very different from Bitcoin, for example. The NFT viewed by the IRS, an NFT is a unique, non-fungible digital asset or token that represents either text, image, video, music, or some form of copyright. Therefore, while the NFT is not a currency per se, no interference should be drawn with respect to virtual currencies not described in this notice. The notice being referred to in this case is Notice 2014-21. In general, once a sale or exchange of virtual currency occurs, be it for goods, services, holding as an investment, it can be taxed. To be prepared, plan for a tax rate of 37% on any profits made from any sale or exchange. Now, there is a phrase in the digital space called HODL. It means hold on for dear life. In essence, it was a rallying cry for persons to hold their assets over the long term. For taxes, the HODL approach works, as it's the actual trade or exchange that triggers a taxable event. Therefore, can an NFT increase in value and you not owe any taxes? The answer is yes. But once a taxable event is triggered, like a sell or exchange, Uncle Sam is due a piece of the flesh. Additionally, taxable events can be predicted, as again, the IRS has not given specific instructions as to the treatment of NFTs. But the expected approach is as follows. The actual creation of the NFT is not a taxable event. The code does not tax imputed income. However, if a buyer pays for artwork and then transforms it into an NFT, the entire purchase price would be taxable to the artist under Section 61. On the issue of copyright and royalties, smart contracts that are embedded in the blockchain technology give the NFT a unique characteristic in that every sale or viewing along the lifetime of the NFT can generate royalties for the creator. These funds would be auto-collected and sent to the creator's wallet. The income is taxed at regular income and requires reporting. So in some cases, a taxpayer may amortize its adjusted basis in the NFT using the straight line method over the course of 50 years, beginning in the month in which the NFT was acquired. Amortization deductions would be allowed, and any potential losses such deductions generated would also be allowed, as long as the taxpayer meets all of the loss limitation rules included in Code Section 465, the passive activity loss rules in Section 469, and the business loss rules in Section 461. If the NFT is created by or for the taxpayer, Section 179C2 generally precludes its adjusted basis from being amortized. However, if an NFT is purchased, Section 197 provisions applicable to intangible assets use may apply. So assuming Section 197 applies, the NFT is not excluded as self-created and is used in a taxpayer's trade or business to generate income. Now, let's talk about establishing legitimate economic interest with NFTs and CryptoPunks. Legitimate interest represents the series or process of thoughts and actions needed to serve an economic purpose. This is a combination of legal and economic observations. For example, importing a container of goods for sale in a local store, or using leads sourced with consent to market to and sell to homes, offices, and other businesses. Please note, when you're taking loans on your assets, they do not trigger a taxable event. You're only taxed based on profits or losses. But this moves into a gray area of the law based on establishing legitimate economic interest. For example, when you take a loan, are you only consuming the cash to support your lifestyle? Or is the cash being used to develop a business system or strengthen the supply chain of a current business? Well, to prevent an IRS probe, it is advised to volunteer the information or be prepared to keep the profits offshore. If the exchange or marketplace is decentralized, then there is no one there for the IRS to subpoena for your record of transactions. However, the information is on an open ledger, and if they choose to make you the center of any blockchain analysis, then your digital ID can be discovered, and then they can estimate the amount you will owe. This may be an arbitrary number. Then you'll be expected to pay late fees that go up to an additional 70% on the amounts that are due. The IRS has made it very clear that there is an option for penalty relief, but it only happens if there was an effort to meet tax obligations, but you were unable to do so based on certain circumstances and situations that were beyond your control. Well, then that means that the burden is on the taxpayer to keep detailed records of all cryptocurrency and NFT transactions to comply with IRS requirements for establishing investor status, basis, and subsequent gains or loss calculations. Now, let's talk about non-taxable exchanges. Some exchanges of property cannot be deducted until you sell or move the property received in the exchange. So what do you do if there is income generated but no cashing out to a fiat or a stable coin? Well, income earned from NFTs is subject to capital gains tax rates of up to 20%. If NFTs are not converted into cash, investors may suffer taxable consequences even without generating income from NFTs. Being an investor, a dealer, collector, trader, and broker make a difference in what forms are used and what activities are to be reported to the IRS. So at the end of the day, if you're buying NFTs and you're deciding to sell these NFTs, you're gonna deal with some tax consequences that could be unavoidable. Does it make sense to purchase NFTs? It might make sense because we're on the cutting edge of an economic advancement into the digital space, and it seems like there's a lot of utility here. As an investor, it might be important for you to jump into an opportunity like this, but like any investments, you need to know exactly what you're investing into. In today's video, we just covered the tax consequences of NFTs, cryptocurrency, and I hope it gave you enough incentive to learn more, because that is truly what this video was for, to give you information, but allow for you to feel encouraged to learn more. My name is Karlton. If you guys enjoyed this video, feel free to like, comment, subscribe. I will be checking your comments so I can respond back to you. And I'll see you in my next video. Cheers.